This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. And just further evidence that Mr. Taylor and I react to immediate information. We both got alerted to a Jamie Dimon article on CNBC in the last 5 minutes. We're like, let's talk about that. How you doing,
Now.
Taylor? Yeah, exactly. Right
I'm
now.
doing
Video
great.
number 2.
Thanks for having me. I love this. I love it. Off the cuff. Here we go. We're going to see what he says and we're going to react.
Yeah, so I'm going to read the title for folks so you can find it. It's on CNBC. It came out at 12:25 Eastern, so literally the last 20 minutes. This is serious. JP Morgan's Jamie Dimon warns the U.S. likely to tip into a recession in the next 6 to 9 months. And he has even more scary thoughts below in the article. So what did you think, Taylor, when you scanned it? What do you think?
I think the headline is, thanks, Jamie. We've been saying that now for
Yeah,
8 months.
welcome to the team, buddy. I'm glad to have you.
Day late and a dollar short, pal. But yeah, that was my initial reaction. Recession in the next 6 to 9 months. I think the betting odds right now are saying better than that, better than 50-50.
Yeah,
so it's that's no shock at all. I think it's the underlying subcontext that came along with it that caused me to bite my lip and say, Jamie, what are you doing here, kind of thing. But no, the 6 to 9 month recession, I think we're absolutely headed for that if we're not in a recession right now.
Yeah. So there's a couple of things that again, I will point out that I often point out in my daily financial news. Billionaires, which Jamie Dimon, I'm sure, is one, are being paraded on CNBC, and they're talking their book. We had a billionaire on last week that was whining and complaining about what the Fed is doing. And suddenly you look at he's an apartment and multifamily investor. I'm like, yeah, you got a lot of bridge debt, buddy. You kind of feeling the pain. You're supposed to feel the pain. They're trying to hurt you. Are you not paying attention? Were you not listening? And now we have Jamie Dimon. Again, I actually bought JP Morgan stock Friday last week. Well, that was Friday. Maybe it's 2 weeks ago.
2 weeks ago, because we talked about it last week, right?
Yeah. First stock I bought in 20 years, right? Or 15 years. So again, I'm a fan. But he is talking his book. I'm sure he has earnings this Friday, right? He's trying to set the stage. But there is a statement now that I scanned through this that I just want to put out there because I think both of you and I need to react to this, and I'll read it to you. It's Jamie Dimon said the benchmark, the S&P 500, could yet fall by another easy 20% from current levels. Adding the next 20% would be much more painful than the first. So what do you think? We're at, let's call it 3,600. So that takes us to 2,900. Easy peasy.
First of all, thanks for the second part, Jamie. The next 20% is worse than the prior 20%. Right. Yeah. Agreed. Thank you.
As a guy that's sitting in cash, it doesn't bother me at all.
Right. Yeah. Good for you. Right. You'll just be licking your chops there going, let's go, baby. Let's go. And I think that's tough to fathom. If you were to say 10% from here, I would say, okay, that's fine. We actually put out a post 2 days ago, and we kind of have it at -8% from here is kind of the over under for us. Does it get there? And it was about a 50-50 polling, and there was a few hundred respondents. And these aren't sophisticated investors by any stretch of the imagination, but I think that that is a pretty good watermark, and that's why we set it at 8%. And it was the post asked, do you think we will see we are within 8% of the conclusive bottom of this market? And it was about a 60-44. 60% thought we were within 8%. 20% from here is a big number. That puts us down 40+%. That puts us down in some of the ultimate meltdowns of all time. And I think that's really tough to fathom. I think when you look at the economy that we're in right now, yes, it's slowing, but it's slowing from a rapid rate, and it's slowing into a labor market that's really backing it up pretty quickly. It doesn't see a fall off in labor, and it's tough for me to fathom another 20% down from here.
So where would 8% put us? I don't know what the market's at. Is the market roughly 36? So we'd be at what? 30?
Yeah, I don't know the number off the top of my head. I hate using the numbers because the numbers become meaningless because, you talk about 100 points a decade ago and you're like, oh my God, 100 points. We see 1,000-point days now. So I just deal in percentages. So, if you see another 8% off the top, you're down. Stocks have been cut by a third from their peak.
Okay.
And that would be in its own right a pretty darn vicious downturn. And the tough thing about these downturns are that they aren't, just precipitous downturns like they were during COVID. COVID traded off about a third. So about 32, 33%, somewhere in that ballpark, but it was overnight. And so this one is that 25% gap down in June. We've bounced along. We're touching that bottom of 25% down. Another 8% down from here is not necessarily unlikely, and it will be painful because it'll be one of those things where you think we've gotten ahead of it and you get a bounce in the market and you get another 5% back and you're like, all right, we take a breather. We're going to set a bottom here and move up, and then it gaps down again. It is tough. This is that early kind of 2000s type mentality that's playing out right now, where 2000 was bad, 2001 was bad, 2002 was bad. Hopefully we don't need to go on for 3 years here. Hopefully we can truncate it inside of a year, year and a half, but that it's not to say that it couldn't stretch out over a couple of years here.
Yeah, so I'll use numbers just because it's easy for people to look at. So something I called months ago, and you can go back to, I think the guy stock trader I talked to on Sundays, I always said 3,200 would get my attention. I think 8%, roughly speaking, off of where we are, 3,600 gets us to 32. That's where I start deploying capital more precipitously, I think. Yeah, and if we got to 2,900, I will move other cash to come in. Right.
You will renegotiate things to get cash to work. I think that's a great move. We put out something on Instagram the other day. It talked about when you actually see the market tick down 25%. So the day it ticks down to 25%, which it did in June, if you deployed capital on that day, on average, when you look at the last 9 times it happened since the 50s, the next 1 year out period from there, you're up 22% on average. 3 years, you're up 37%. And 10 years are up 213%. So obviously this is saying once it gets bad, it's better to get money to work than it is when it's really good, like at the end of 2021, when everyone wanted to put money to work. But that doesn't say that at 25%, you put money to work. It doesn't go down more from there. Before that 1 year out, it winds up 21, 22%, whatever that number is. It's 21 or 20. I think it was 22%. But yeah, the last thing I'll add is just, guys, you have to remember that every time the market's down this much, there's damn good reason the market's down this much. The market doesn't go down this much because there's a whim and a couple people think that the end is coming, this and that. It goes down because you have a .com blow up. It goes down because you have a great financial crisis meltdown. It goes down because you have inflation hit 20%. It goes down because COVID hits. Those are the reasons why the market pulls back 25%. It doesn't pull back 25% on a whim. This time isn't different, is what I'm saying.
No, I'm absolutely right. So let's rope into this conversation what we had planned for video number 2, which was kind of three discussion points that Mohammed El-Arian has been out. And I think he's pissed off because he's always paraded around, he likes to be this highfalutin economist, but I think he's really mad now. And he was out this weekend all over the place and basically saying the Fed is going to crash us into a recession, probably a deeper recession than the average one, because they've made 3 mistakes, and I want you to react to them. The first mistake is they said transitory. Second mistake is they kept injecting liquidity when we printed 5% inflation. They just kept the hammer down. And now they're raising us straight up. Do you think all 3 of those are mistakes and the Fed should own all 3 of those?
So I'm actually, and this is not a popular opinion, I'm going to give him a pass on the first one. So saying it's transitory, okay. I'm going to give him a little bit of a pass on that one. Inflation is a scary problem. Deflation is a scarier problem. Ask Japan. Ask Japan what happened from the 1990s through the 2015 timeframe. Their stock market did nothing. Why did it do nothing? Because they had deflation in their economy. Mm-hmm. And what happens if you raise rates too much into a COVID-induced economy that got shut down globally intentionally? Yeah. You can get a deflationary spiral out of that. And if you get a deflationary spiral, there is no fix. We literally sent every economist around the world to Japan to sit down with them and say, hey, how are we going to fix this? This is a multi-decade problem that you guys have. How do we fix this? And they said, inject money, lower rates, cut rates to negative. All of those things were tried. Nothing caused inflation in their market. So I'm going to give them a pass on transitory because this was the first time we ever took the economy and said, time out, economy shut down. We're forcing the shutdown.
I'm going to give them a pass on the first 6 months of transitory.
Okay. At some point, there may have been a point where you're like, okay, guys, like the numbers
come on now.
So that's fair. That's fair. That's fair. Okay. I totally agree with Muhammad on the second point. And we talked at length about this. And this was back to when transitory was like, when you and I started talking, it was probably in February-ish, and transitory was still getting used. Mm-hmm. And I was still giving them a little bit of pass. And I was saying on the other side, though, you're buying bonds in this market.
I
You're
remember.
driving mortgage rates down when mortgages are essentially out there in the market for free, driving up housing prices, which are now up double digits for 2 years in a row. Housing prices went up at 20% for the last 2 years in a row, and they're out there buying mortgage bonds, pinning them down. That was crazy. That was where I think that you look at them and go, I cannot see what you're looking at in order to do this. It was like their only thought at that point was on what are we doing with rates? What's happening with inflation? We're not worried about the bond purchase program. That's secondary. We're going to think about that after we figure out what we're going to do with rates, because that's what everyone cares about.
Yeah, no excuse. Again, I've said the Fed broke housing. It's, will be one of those quotes I assume that my name's attached to for quite a while. And that was a moment. And what I think happened is my belief, one guy's opinion. Powell is stuck on telling the market what's coming. In February or March, we got a 5.1 inflation print, and he had not told the market that he was going to stop buying. So he didn't stop buying. I'm like, you idiot.
Yep.
That was wrong. Now let's talk about number 3. Go ahead.
And what his fear was, we were going to upset and ruffle the market overnight.
Yes,
okay, do it, right? Do
Yeah.
it. Get it out of the way.
Yeah, rip the damn Band-Aid off, dude. Stop ripping one hair at a time. That's
slow
freaking
bleed. Yeah, exactly. The one leg hair that's coming off at a time really hurts.
It hurts. Just doesn't stop. But now number 3, he has gone parabolic. We've only seen. I actually went back and looked at 81. We've been here before, but on a percentage basis, we've never been here before. We have raised
because
rates.
in 81 rates were already higher to begin with. Right. Yep.
Exactly. So we have seen a rate increase like this, but never a percentage increase like this. And I think you and I would both agree we're getting another 75 on November 2nd, which will take us to 4%.
My thoughts on this right now are, in hindsight, if we look back, inflation's controlled right now. Inflation is controlled right now, but I don't think the degree of certainty is high enough. And I think that we did see in the 70s that you cannot raise, stop, and then Volcker came in and just said, I'm going to slam on the brakes until the car behind me slams into me. And that's what's going to happen, because we need to get this thing under control. And if you look at inflation during the 80s, so again, Volcker was raising in the late 70s into the 80s, and then inflation didn't get back down to that 2% target until 1986. So this isn't something that just happens overnight. Again, I do think that if they were to stop and move sideways from here, things would be under control. And I think, if you had asked me 2 months ago, and I would say where we are right now, we're going to be fine, I'm not confident there now. And a lot of that goes to, again, some of these underlying commodity prices starting to tick back up. Oil, the food input costs of corn, wheat, soy, et cetera, are starting to tick back up. That's a scary thing.
Yeah. I don't think inflation is beat. At some point the Fed is going to have to pause. So let's talk about the Fed pivot, and then we'll shut this one down. The Fed can pivot one of 3 ways. One, they could be Bank of Australia, and they could deliver 25 instead of 50. They under-deliver. 2, they could pause. And 3, they could cut.
Yep. Or 4, they could roll off quicker what's on their balance sheet.
Oh, they could do QT faster.
Their quantitative tightening could be more rapid in its pace.
Okay, so let's talk about all 4. And let's just through the rest of the year. I'm going to say I've been calling for 75, 50 the next 2 meetings. If they do anything less than those 2s, that would be Bank of Australia, in my opinion. I don't see it, but what about you?
Yeah, I've been wrong on this. They are going to stop quicker than they are, that recession's going to set in quicker than it has. And again, I actually think that recession has set in. So I haven't necessarily been wrong on the economic front, but just the reaction of what the Fed has to do in order to get us there. And I have been wrong in the fact that I thought unemployment would roll over quicker. It's tough to say that you're in a recession and unemployment hasn't rolled over. It's really hard.
The other way.
Exactly right. So now what we're going to see, this is going to be interesting, is that unemployment's going to pick up and the stock market's going to rally off of it. What? Unemployment, people are losing jobs and the stock market's going to rally? That's crazy. Yeah. So going back to your question, though, I think that's probably when they pivot, that's how it's going to happen. They're going to ease into this thing, right? So they're not going to hit the brakes as hard. That's the easy way out to say, okay, we are still raising rates. We still have not controlled inflation, but we need to get off the the brakes, I guess. Get off the brakes on this. Yeah.
So this is what I see coming for the next 4 meetings. 75, 50, 25, pause.
Pause. Yep. Yeah. I don't think that's I don't think that's a ridiculous thought at all. It'll be interesting to say. There's a long time between now and when this stuff starts to play out. So there's a lot of data that's going to leak back to the system. But I think you're probably right. I think that I'll stay on the side that I have been on, and to my prior comments that I think inflation is already under control. And I know that's not a popular take on that at all. I think we get 2 movements this year of 75, 50, and then that's probably it.
Right, so you're pause Q1. Yeah,
Yep.
Again, I think Powell is just, we're going to walk this down. 75, 50, 25, pause.
Yep.
So we're off a month.
You're not at all out of bounds saying that. I think that's probably a very logical progression over the next 3 meetings.
And then the last thing I want to close on is this mysterious rate cut that Cathie Wood and Elon Musk and others are calling for. It used to be September, then it was November, and now they're whenever. I want to be very clear. If we get a rate cut next year, something massive broke. Massive.
Correct.
I don't want
and
that.
it could be geopolitical, right? Because what's going on? What's playing out right now in the Middle East is scary. There's a guy control there that is losing a war, and when dictators lose a war, they can do crazy things, and that's what history tells us time and time again too. But how do you invest off that? That's a binary result that you can't necessarily invest off of. I think that you do, as an investor, have to think about the tail risk. I think that is the tail risk. So if you were to say, okay, I'm really, and investors don't do this either, but I'm really confident that inflation's behind us, I'm going to get on the gas. You can't wholeheartedly and fully get on the gas and say I'm taking on risk assets, because there are those massive outliers standing in the way there that are the geopolitical risks that haven't been there to the degree that they are right now for a couple decades.
Do you by chance listen to the All In podcast?
No, I don't. No. Who is that?
Right, so All In podcast are 4 best friends. One of them is Chamath Palihapitiya. Do you know who Chamath is?
Yeah.
He's SPAC guy, all of that. I think it was 2. Yeah, that one. I'll just call him Chamath.
Haven't seen his name in a while anyway.
Yeah, exactly.
Or many SPACs rolling out.
Yeah, so I want to ask, because I think it was 2 weeks ago. I've not asked anybody this. I can't believe he said this. I hope I misheard it. But I believe what he said 2 weeks ago was, hey, if this crazy guy in Russia gets backed into a corner, he drops a tactical nuke, he didn't think the stock market would react. I totally disagree. I think that's a tail risk.
Comment.
Yeah, the market shits the bed. It freaks out. It's down 1,000 points.
Correct.
It's down. It's limit down. Like,
correct.
We will hit 10%, which I think is the what are they called? Circuit breakers?
Yeah, the stop mark or whatever it is. Yeah. They have 4,500. This number shocked me, and I believe I'm stating this correctly, so you might have to fact check me on it. But they have 4,500 nuclear weapons, which is an absurd amount of nuclear weapons. They were talking about, I was reading an article on this, and they were talking about the fact that they have 4,500 nuclear weapons. Almost every single one of them have an effect larger than what we did in Hiroshima and Nagasaki. Which is, I mean, there's nothing crazier than that. For someone to come out and say that they could drop one of those and it not to have we wiped out a lot of Japan and caused decades and decades worth of effects on that country. That it's absurd to say. I don't even know what the justification is. Like Ukraine doesn't have that much economic effect to the.
Yeah,
it was
crazy. I think what he was trying to say, and it was such a ludicrous comment, I didn't want to go back and listen to because I just violently disagree.
You were getting clickbaited into that. You didn't want to.
I was like, you're crazy to say something like that. Right. If that goes off, I mean, it's game changing. World War III starts. I mean, just bad stuff happens. So if I do not want that, I don't wish that. I hope it's not. To me, it is so irrational that I just had to ask somebody else who's in.
And I'll just say one more thing on this. Like, not that countries are entrenched. There are countries entrenched, obviously, against Russia, and most of them, the major powers of the world, the European market, us, but on the other side, if China was taking one side of this or the other, they have leaned more on the Russian side. Now, if Russia did that, it's not to say China's not like, okay, now you really are crazy. Like,
Yeah. I actually
we can't
think
be
that-
friends
no.
with you now, but that's not to say
but it
that they
could.
haven't more aligned with the Russian side than they have with us. India might be right there in that camp as well, at least from an economic standpoint. They've been taking in all of Russia's oil. So those are two of the biggest populations in the world that you don't know exactly how they're going to react.
Well, yeah, it just felt like a ludicrous comment. I can't believe he said that. I can't believe more people haven't called him out on it. And again, maybe I heard it wrong. Maybe the ifs and ands or the buts in the podcast. Yeah, who knows? But I just wanted to ask somebody. It would definitely, the stock market would be instantaneously crazy.
No argument. No argument.
Okay, very cool. Well, do me a favor. Where can people find you?
Yeah, find us at Life Goal Investments on Instagram. That's the best place. We put out daily stuff that's mostly
It's really good.
macroeconomic, et
Yeah,
cetera.
it's really good. Yeah, you're doing macro stuff in a way that a non-economist can understand, and it's very valuable stuff. What's the page name one more time?
Yeah, it's at Life Goal Investments.
Awesome.